Hello everybody. Today we are going to present about the basic principles of reinsurance. What is reinsurance? Reinsurance is a contract of insurance by which one insurer, who is called the reinsurer or assuming company, agrees for a portion of the premium to indemnify another insurer, who is called the reinsured or ceding company, for losses paid by the latter under insurance policies issued to its policyholders. Under the insurance contract, the insured will transfer the risk to primary insurer, and the primary insurer will transfer the risk to reinsurer by paying the premium. And under the reinsurance contract, the reinsurer will transfer the risk to primary insurer, and the primary insurer will transfer the risk to insured by giving indemnity. Elements of reinsurance. The subject matter of a reinsurance contract is the insurance liability the reinsured has assumed under insurance policies issued to its own policyholders. A reinsurance contract is an indemnity contract even in life and personal accident insurance caused by insurance policy obligations. Here comes what reinsurance does. It will redistributes the risk of loss which a reinsured incurs under the policies it issues according to its own needs. Other than that, it will redistributes the premiums received by the reinsured according to its own needs. Next is what reinsurance does not do. Convert an uninsurable risk into an insurable one. Make loss either more or less likely to happen. Make loss either greater or lesser in magnitude. Convert bad business into good business. Purpose for reinsurance is most risks, both natural and man-made, are insured, and yet the likely losses are often beyond the capacity of any single insurance company or even insurance market. Moreover, reinsurance is therefore the means by which insurance companies obtain the necessary protection. These are the examples of nature and man-made risks. There are two main purposes of reinsurance, which is avoid bankruptcy of insurer and increase underwriting capacity without increase the capital. Avoid bankruptcy of insurer is like an insurer has to maintain a balance of readily realizable assets to pay its claims liabilities to policyholders as they become due for settlement and longer-term investments to maximize growth opportunities. Then, increase underwriting capacity without increase the capital is like a capacity of insurance company is its ability to provide a limit of cover in the policy issued to its insured. The insurance company is providing a promise to pay when an insured meets claims, so it will aim to have a gross capacity before the application of any reinsurance which is big enough for it to write most of the business it found or is offered. They also have other purposes for reinsurance. An insurance company would therefore buy reinsurance to protect its capital and its shareholders, to stabilize its results from year to year by leveling claims fluctuations, to increase its capacity to handle larger and more complex risks of various classes, to maintain any statutory minimum solvency requirements and provide security, to spread risk throughout world markets, not just locally, to lessen financial impact on any single economy, to limit concentration of risk, and to take advantage of risk expertise of reinsurers who have greater experience of business. Now, let's see the benefits of reinsurance. Reinsurance will stabilize premium rates. The premium rates of reinsurance are stabilized by reinsurance. Reinsurance takes account of all this data, which is loss experienced by the insurer, and fix the premium rate according for various types of risk under mutual agreement. Secondly, reinsurance boosts insurance business. The major advantage of reinsurance is that it assists in the boom of insurance business. It enables every insurer to accept insurance business as the total risk will be distributed among other reinsurers. Other than that, reinsurance reduces the risk. The prime principle of insurance is to reduce risk. As the risks are spread across wider area, the loss of the individual is minimized, which gives the insurer the secured feel. The revenue of insurance companies are stable due to reinsurance. Moreover, reinsurance increases goodwill of insurer. Reinsurance helps to boost the overall confidence and goodwill of insurer. When the insurer develops confidence, he understands the nature of risk involved beyond his capacity. So, reinsurance increases goodwill of an insurer. Lastly, reinsurance protects the insurance funds. The insurance funds of the insurer is well protected due to reinsurance. Additional security and peace of mind is an added advantage of reinsurance for the insurer and the company that offers the insurance.
Next, the reinsurance market. Reinsurance brokers has direct connection with insurance company, reinsurance companies and retrocessionaries. The owner of the insurance policy holder will transfer their premium revenue to insurance company, while insurance company will pass their risk to reinsurance company, and reinsurance company will pass a part of the benefit of expenses to insurance company. Buyers of reinsurance consists of direct writing companies, captive insurance companies, reinsurers, state-owned insurance corporations, state reinsurance corporations, underwriting pools and regional reinsurer pools and corporation. Meanwhile, sellers of reinsurance consist of professional reinsurance companies, Lloyd's of London, direct insurance companies, underwriting agencies, state insurance and reinsurance corporations, insurance and reinsurance pools, and regional reinsurance corporations. Now, we are going to discuss about reinsurance brokers. The reinsurance brokers should advise their clients about proper retention and accurate capacity, market knowledge, preparation of reinsurance contract, collection of premium, claim negotiation and collection, provision of information, and code of conduct. Types of reinsurance. There is two types of reinsurance. First, facultative reinsurance. Facultative reinsurance is coverage purchased by a primary insurer to cover a single risk or a block of risks held in the primary insurer book of business. Facultative reinsurance allows the reinsurance company to review individual risks and determine whether to accept or reject them, and so are more focused in nature than treaty reinsurance. By covering itself against a single or block of risks, reinsurance gives the insurer more security for its equity and solvency and more stability when unusual or major events occur. Next, treaty reinsurance. Treaty reinsurance is insurance purchased by an insurance company from another insurer. This issuing company is called the cedent, while the reinsurer is the purchasing company which assumes the risk specified in the contract for a premium. Treaty reinsurance gives the ceding insurer more security for its equity and more stability when unusual or major events occur. The two types of treaty reinsurance contracts are proportional and non-proportional contracts. Treaty reinsurance is one type of reinsurance, the other being facultative reinsurance and excess of loss reinsurance. Treaty reinsurance also is less transactional and less likely to involve risks that can be rejected. Quota share treaties. A quota share treaty is utilized when an insurer wants to free up cash flow in order to be able to underwrite more policies. A quota share treaty lowers the financial risk to the primary insurer. These types of treaties are enacted when an insurer wants to diversify their risk and is in a position to take less profit from a premium in exchange. Moreover, surplus share treaties. A surplus share treaty is a reinsurance agreement whereby the ceding insurer retains a fixed amount of an insurance policy's liability while the remaining amount is taken on by a reinsurer. When engaging in a reinsurance treaty, the insurer shares its risk and premium with the reinsurer. Entering into such an agreement reduces the insurance liability and frees up capacity to underwrite more policies. The reinsurer does not participate in all of the risk in a surplus share treaty, only if the amount of the claim is above the limit set in the treaty. Now we can talk about co-insurance. Co-insurance is a risk sharing between insurers. Insurer agreeing with other insurers the rating and the terms to be applied, issuing what is known as a collective policy, and each insurer receives a stated proportion of premium. Moreover, pay a same proportion of any losses that occur. Difference between reinsurance and co-insurance. Reinsurance is providing insurance for the risk that has been already taken up by an insurance company, while co-insurance refers to sharing one risk among multiple insurance companies. Moreover, reinsurance is considered as the transfer a part of the risk taken by the direct insurer to the reinsurer, while in co-insurance all the parties to the agreement are direct insurance. Under reinsurance, the reinsurer has no direct connection to the policyholder or insured, while under co-insurance, all insurer has direct connection with the policyholder or insurer. Lastly, reinsurance is designed to limit the spread of the risk associated with direct insurance, while co-insurance is designed to cover the risk that exceeds the capacity of one of the insurance company. That's all from us. Thank you.